There's a quiet shift happening beneath the surface of the markets right now, one that most people won't notice until it's already priced in. Liquidity is tightening, debt is no longer cheap, and the assumptions that carried the last decade of growth are starting to crack. When the cost of capital rises this fast, something usually breaks, and historically, it's not where the crowd is looking. The real question isn't whether recession is coming, but where the smart money is going before it. Reality becomes obvious. That shift starts with liquidity, and right now liquidity is moving in the wrong direction. For years, markets were conditioned to operate in an environment where money was not just available, but abundant. Central banks expanded their balance sheets. Interest rates hovered near zero, and risk-taking was consistently rewarded. That backdrop didn't just support asset prices, it became the foundation for how investors thought about opportunity itself. But that foundation is now being pulled away, slowly at first, and then all at once. When central banks tighten policy, they're not just raising rates, they're removing fuel from the entire financial system. Every dollar that becomes more expensive to borrow is a dollar that won't be deployed into equities, real estate, or speculative bets. It forces a repricing of risk across the board. What used to work effortlessly in a low-rate world suddenly becomes fragile. Leverage, which once amplified gains, starts amplifying losses. And the higher rates go, the more unforgiving the system becomes. What makes this cycle particular? Markets have become on easy liquidity. Over the past decade, capital wasn't just cheap, it was almost taken for granted. Companies borrowed aggressively, often not because they needed to, but because it made financial sense to do so. Investors chased yield wherever they could find it, pushing valuations to levels that only made sense under the assumption that money would remain easy indefinitely. That assumption is now being tested in real time. You can already see the cracks forming in subtle ways. Credit spreads begin to widen, not dramatically at first, but enough to signal rising concern. Refinancing becomes more expensive, especially for weaker balance sheets. Projects that once looked viable under lower discount rates suddenly don't meet the hurdle. The system doesn't collapse overnight, it tightens, piece by piece, until the pressure becomes impossible to ignore. The key dynamic here is that liquidity doesn't disappear evenly. It retreats from the margins. For areas feel it early: unprofitable companies, high growth narratives, anything that relied heavily on future expectations rather than present cash flows. As funding dries up, these areas start to reprice sharply. Investors who were once willing to overlook risk begin demanding a much higher premium to stay invested. That shift in behavior is often the first real signal that conditions are changing. At the same time, there's a lag effect that makes the situation more deceptive. Economic data may still appear stable, employment may hold up, and corporate earnings might not immediately reflect the tightening. That creates a false sense of security, leading many to believe the system can absorb higher rates without consequence. But liquidity operates with a delay. What's being restricted today shows up in economic weakness months down the line. Another layer to this is the global nature of liquidity. When major central banks tighten simultaneously, there's no easy escape valve. Capital becomes more selective, flows become more volatile, and emerging markets often feel the pressure first. Currency fluctuations, capital outflows, and rising borrowing costs create a feedback loop that reinforces the tightening cycle. What starts as a policy decision in one region quickly ripples across the entire financial system. Markets are particularly sensitive to this because they are forward-looking. They don't wait for the full impact to be visible. They start adjusting as soon as the trajectory becomes clear. That's why liquidity cycles tend to create sharp, sometimes violent, moves in asset prices. When the tide is going out, it doesn't just lower everything evenly. It exposes vulnerabilities that were previously hidden. There's also a psychological component that can't be ignored. Investors who have only experienced a liquidity-rich environment tend to underestimate how quickly conditions can change. They anchor to recent history, assuming that any weakness will be met with policy support or a return to easier conditions. But when central banks are focused on controlling inflation or stabilizing currencies, their willingness to step in is significantly reduced. That changes the entire risk calculus. In this kind of environment, the cost of being wrong increases dramatically. Positions that once had time to recover are forced to adjust quickly. Margin calls, redemptions, and forced selling start to play a larger role. Liquidity doesn't just shrink, it becomes more fragile, more reactive, and more prone to sudden dislocations. The margin for error narrows, and the consequences of misjudgment become more severe. And as that margin for error narrows, the pressure begins to shift from markets to balance sheets. Rising debt costs don't hit all at once, they creep in quietly at first, then relentlessly. For governments, companies, and consumers, the entire system was built on the assumption that borrowing would remain manageable. When that assumption breaks, the strain doesn't just show up in numbers, it starts to alter behavior. Take governments first. For years, deficits were easy to finance because interest rates were low and demand for sovereign debt was strong. Rolling over debt wasn't a concern, it was routine. But as rates rise, that rollover becomes significantly more expensive. Even a small increase in average borrowing costs can translate into massive jumps in interest payments when applied to trillions in outstanding debt. Budgets that once had flexibility begin to tighten, forcing difficult choices between spending, taxation, and further borrowing. And the more debt a government carries, the more sensitive it becomes to every incremental rate increase. What makes this particularly precarious is the timing. Many governments expanded their balance sheets aggressively during periods of crisis, issuing debt when it was cheap and abundant. That debt doesn't disappear, it matures, and it needs to be refinanced. Now, instead of rolling it over at near zero rates, they're facing a much higher cost of capital. The math becomes unforgiving. Interest payments start to crowd out other priorities, limiting the ability to respond to future shocks. Corporations are facing a similar reality, but with an added layer of risk. During the era of easy money, companies leaned heavily on debt to fund expansion, buybacks, and acquisitions. It wasn't just large firms, even mid-sized and smaller businesses took advantage of cheap financing. In many cases, leverage levels increased not because necessary, but because it boosted returns in a low-rate environment. Now that rates have risen, those same leverage decisions are being evaluated under far less favorable conditions. Refinancing is where the stress becomes visible. Debt that was issued years ago at low rates is coming due, and replacing it now comes at a significantly higher cost. For companies with strong cash flows, it's a manageable adjustment, though still painful. For weaker firms, it becomes a serious problem. Interest coverage ratios shrink, margins compress, and what once looked like sustainable debt suddenly feels burdensome. Access to capital markets may still exist, but it comes with stricter terms and less tolerance for risk. Consumers, meanwhile, are experiencing the impact in more immediate ways. Higher interest rates translate directly into more expensive mortgages, auto loans, and credit card balances. Monthly payments rise, disposable income shrinks, and spending patterns begin to change. What's important here is not just the increase in costs, but the cumulative effect across millions of households. As more income is diverted towards servicing debt, less is available for consumption, and that feeds back into the broader economy. There's also a behavioral shift that accompanies this. When borrowing becomes expensive, people and businesses alike become more cautious. Projects are delayed, purchases are reconsidered, and risk appetite declines. The same dynamic that once encouraged expansion now encourages restraint. And while that might sound like a healthy adjustment, it can slow economic activity more quickly than expected. Another critical factor is the uneven distribution of debt. Not everyone is affected in the same way. Those with fixed rate obligations may feel insulated for a time, while those with variable rates experience immediate pressure. Similarly, entities with strong credit profiles can still access financing, albeit at higher costs, while those on the margins may find themselves effectively shut out. This creates a divergence where the strongest survive, but the weakest begin to struggle. As stress builds, it often surfaces in the credit markets before it becomes obvious elsewhere. Lenders tighten standards, becoming more selective about who they extend credit to. Defaults, which may have been low during periods of easy money, start to edge higher. Each default doesn't just represent an isolated failure, it sends a signal, prompting further caution and reinforcing the tightening cycle. What ties all of this together is the feedback loop between rising costs and slowing activity. Higher interest expenses reduce profitability and spending, which in turn weakens growth, making debt even harder to manage. It's not a sudden collapse, but a gradual constriction that becomes to reverse the longer it persists. The system adjusts, but not without friction, and not without exposing the vulnerabilities that were built up during years of cheap and abundant credit. And those vulnerabilities don't stay contained within balance sheets, they start to show up in expectations, particularly in how markets view earnings. Right now, there's a growing disconnect between what companies are likely to deliver and what investors are still pricing in. On the surface, forecasts can appear reasonable, even optimistic, but they're often built on assumptions that no longer align with tightening liquidity and rising costs. That gap between perception and reality is where the real risk begins to build. Earnings projections tend to lag reality, especially at turning points. Analysts rely on models that extrapolate from recent trends, adjusting gradually rather than abruptly. When conditions shift quickly, those models struggle to keep up. Revenue growth may still look solid on paper, margins may appear stable, and guidance might not yet reflect the full impact of higher financing costs and slowing demand. But beneath those numbers, pressure is already building. One of the most overlooked factors is how sensitive margins are to changes in the cost environment. During periods of low rates and strong demand, companies able to expand margins with relative ease. Input costs were manageable, financing was cheap, and pricing power to offset occasional increases in expenses. Now, that balance is shifting. Higher interest expenses eat into profits, while slowing demand makes it harder to pass on rising costs to customers. The result is a squeeze that doesn't always show up immediately, but becomes more pronounced over time. There's also the issue of operating leverage. Many businesses scaled their cost structures during periods of growth, assuming that revenue would continue to expand at a steady pace. Fixed costs increased, hiring accelerated, and long commitments were made based on a certain trajectory. When growth slows, those costs don't adjust as quickly. Even a modest decline in revenue can lead to a disproportionate impact on earnings, catching both management and investors off guard. What makes this more complex is the role of expectations themselves. Markets don't react to absolute numbers, they react to the difference between what was expected and what actually happens. If expectations are set too high, even solid performance can be perceived as a disappointment. That's where the current environment becomes particularly fragile. Optimism that was justified in a low-rate, high-liquidity world is now being carried forward into a very different landscape. Guidance from companies often reflects this lag as well. Management teams are cautious about revising outlooks too quickly, partly because visibility is limited and partly because sudden changes can trigger sharp market reactions. As a result, adjustments tend to come in stages. Initial signals may be subtle, slightly lower growth targets, cautious language around demand, or increased focus on cost control. But as conditions persist, those signals become more explicit and revisions start to accelerate. Another layer to consider is how different sectors respond to these pressures. Cyclical industries tend to feel the impact earlier, as they are more directly tied to economic activity. Consumer discretionary, industrials, and certain segments of technology can see demand soften relatively quickly. Defensive sectors may hold up better initially, but they are not immune. Over time, the effects of reduced spending and tighter financial conditions tend to spread more broadly across the economy. There's also a timing mismatch that adds to the complexity. Costs often adjust faster than revenues. Interest expenses increase almost immediately for variable rate debt, while demand may take longer to weaken. That creates a period where margins are compressed from both sides, even before revenue declines become fully apparent. By the time earnings reports reflect this reality, markets may have already begun to reprice, leading to sharp and sometimes abrupt corrections. Investor behavior plays a crucial role in amplifying these moves. When confidence in earnings starts to erode, valuations come under pressure. Multiples that were once justified by strong growth expectations begin to contract. This doesn't require a collapse in earnings, just a shift in perception. As uncertainty rises, investors demand a greater margin of safety, which translates into lower valuations even if the underlying business remains relatively stable. The challenge is that this process rarely unfolds in a straight line. There are periods of resilience where data comes in stronger than expected and optimism briefly returns. Those moments can reinforce the belief that the system is more robust than it actually is. But if the underlying pressures remain unresolved, each rebound becomes more fragile, setting the stage for further adjustments as reality continues to catch up with expectations. As that adjustment unfolds, the movement of capital becomes more deliberate, more selective, and far less forgiving. Investors are no longer chasing broad market exposure with the same confidence. They're narrowing their focus, looking for resilience rather than potential. This is where the rotation begins, not as a sudden shift, but as a gradual reallocation toward assets that can withstand pressure rather than depend on ideal conditions. In an environment defined by tightening liquidity and rising costs, cash flow starts to matter more than narrative. Companies that can generate consistent, predictable income become significantly more attractive than those promising growth at some undefined point in the future. It's a subtle but critical change in mindset. The question shifts from how fast something can grow to how well it can endure. Stability begins to command a premium, even if it lacks the excitement that once drove market enthusiasm. You can see this in how investors reassess risk. High-growth sectors that thrived on cheap capital begin to lose their appeal, especially when profitability is still distant. The tolerance for uncertainty declines, and the willingness to fund long-duration bets weakens. In their place, capital starts to flow toward businesses with strong balance sheets, manageable debt, and the ability to sustain operations without constant external financing. These are not always the most glamorous opportunities, but they are the ones that offer a higher degree of control in an unpredictable environment. Dividend-paying stocks often come back into focus during these periods, not simply because they provide income, but because they signal financial discipline and stability. A company that can consistently return capital to shareholders while maintaining operations is generally one that has already proven its resilience. That doesn't make it immune to broader market forces, but it does make it less dependent on favorable conditions to justify its valuation. Beyond equities, there's also a shift toward assets that preserve value rather than amplify risk. Cash, which was often dismissed in low-rate environments, starts to regain its appeal. Higher interest rates mean that holding cash is no longer a guaranteed loss in real terms, and the optionality it provides becomes more valuable. Investors gain the ability to wait, to be selective, and to deploy capital when opportunities are clearer rather than being forced to stay fully invested at all times. Fixed income, particularly in higher quality segments, begins to look more attractive as well. When yields rise to levels that offer a meaningful return, bonds can once again serve as a viable alternative to equities. This is especially true for investors who prioritize capital preservation over aggressive growth. The dynamic changes from there is no alternative to a more balanced evaluation of risk and reward across asset classes. Commodities and real assets can also play a role in this rotation, particularly in environments where inflation remains a concern. These assets tend to have intrinsic value and can act as a hedge against currency depreciation or supply constraints. However, they are not without volatility, and their performance often depends on broader economic conditions and geopolitical factors. The key distinction is that they are being considered not as speculative plays, but as part of a broader strategy to diversify risk. What's important to understand is that this rotation is not uniform or synchronized. Different investors move at different speeds, and the process can be uneven. Some will hold on to previous positions longer, hoping for a reversal, while others will adjust more quickly, prioritizing preservation over potential upside. This creates pockets of volatility where certain sectors or assets experience sharp moves as capital flows in or out. There's also a psychological shift that accompanies this transition. Confidence, which once drove aggressive positioning, gives way to caution. Investors become more focused on downside scenarios, stress testing their assumptions and revaluing their exposure. The emphasis moves from maximizing returns to managing risk, and that change influences every allocation decision. In many ways, this is where experience begins to matter more. Investors who have navigated previous cycles recognize the patterns, the gradual tightening, the delayed impact on earnings, the eventual repricing of risk. They understand that protecting capital during uncertain periods is just as important as growing it during favorable ones. That perspective leads to more disciplined decision-making, even when it means stepping away from opportunities that might have been attractive in a different environment. As capital continues to reposition itself, the market begins to reflect these priorities more clearly. Valuations adjust, correlations shift, and the leadership that once defined the previous cycle starts to fade, making room for a different set of winners, driven not by optimism, but by durability. And as that new set of winners begins to emerge, another risk starts to stand out more clearly: the concentration that built up during the previous cycle. For a long time, market performance was driven by a relatively small group of dominant companies. Their size, growth, and influence attracted a disproportionate share of capital, and as they continued to outperform, that concentration only increased. It created the illusion of strength across the broader market, even as participation beneath the surface became narrower. This kind of concentration tends to go unnoticed when prices are rising. As long as the leaders continue to deliver, few investors question the structure of the market. Capital flows toward what's working, reinforcing the dominance of those same names. Index funds, passive strategies, and benchmark-driven allocations amplify this effect, channeling more money into the largest components simply because of their weight. The system becomes self-reinforcing, with success attracting more capital and more capital driving further success. But concentration carries its own form of risk, particularly when conditions begin to change. When a large portion of market performance depends on a small number of companies, any weakness in those names can have an outsized impact. It's not just about individual fundamentals. It's about how much expectation is already embedded in their valuations. When expectations are high, the margin for disappointment becomes extremely thin. What makes this dynamic more fragile is how interconnected it becomes with investor positioning. Many portfolios, whether actively managed or passively constructed, end up with significant exposure to the same set of leaders. This creates a situation where a shift doesn't just affect isolated positions, it affects a broad swath of the market simultaneously. When investors begin to reduce exposure, the selling pressure can become concentrated as well, leading to sharper moves than might otherwise be expected. There's also a psychological component that amplifies the risk. Investors tend to develop a sense of confidence in what has worked consistently. The longer a group of stocks outperforms, the more it is perceived as reliable, even inevitable. Narratives form around their dominance, often supported by strong fundamentals, but also by the momentum of past performance. That combination can make it difficult to recognize when conditions are shifting, because the belief in their resilience is deeply ingrained. At the same time, the broader market can become increasingly dependent on these leaders to sustain overall performance. Even if other sectors begin to weaken, as long as the largest names hold up, indices may appear stable. This can delay the recognition of underlying weakness, creating a disconnect between headline performance and the actual health of the market. By the time the leaders begin to falter, the adjustment can feel sudden, even though the groundwork was laid over a much longer period. Valuation plays a critical role here as well. As capital concentrates, it often pushes multiples higher, reflecting not just current performance, but expectations of continued dominance. In a low-rate, high-liquidity environment, those valuations can be sustained because the discount rate applied to future earnings remains low. But as rates rise and liquidity tightens, that equation changes. Higher discount rates reduce the present value of future cash flows, putting pressure on even the strongest companies. This doesn't mean that the leaders necessarily lose their fundamental advantages. Many of them remain highly profitable, well managed, and strategically positioned. The risk lies in how much of that strength is already reflected in their prices. When valuations are elevated, even strong performance may not be enough to justify further gains. Any sign of slowing growth, margin pressure, or increased competition can trigger a reassessment. Another factor to consider is how quickly sentiment can shift once the narrative begins to change. The same momentum that drove prices higher can work in reverse. As confidence weakens, capital that once flowed in steadily can begin to move out, accelerating the decline. This is particularly true in a concentrated market, where the same names are widely held and closely watched. Small changes in outlook can lead to large changes in positioning. The broader implication is that concentration risk doesn't just affect individual stocks, it influences the stability of the entire market. When leadership is narrow, diversification becomes less effective because many assets are indirectly tied to the same underlying drivers. This can increase volatility and reduce the ability of portfolios to absorb shocks. As this risk becomes more apparent, investors begin to reassess their exposure, looking not just at what they own, but at how much of their performance depends on a limited set of outcomes. That realization can lead to a gradual unwinding of concentrated positions, introducing a new layer of uncertainty as capital seeks a more balanced distribution across opportunities. As that redistribution takes hold, the underlying objective becomes clearer. This is no longer a market driven by the pursuit of maximum returns, but by the necessity of protecting what's already been built. The behavior of experienced investors starts to diverge sharply from the crowd. Instead of leaning into risk, they begin pulling back, not out of fear, but out of recognition that the environment has fundamentally changed. Preservation becomes the strategy, not as a defensive reflex, but as a calculated move in a cycle where the odds are no longer symmetric. One of the first shifts you notice is in position sizing. Capital is no longer deployed aggressively across a wide range of opportunities. Allocations become more concentrated in conviction, but smaller in overall exposure. There's an intentional effort to reduce downside risk, even if it means sacrificing some upside. This isn't about trying to time every move perfectly. It's about acknowledging that when uncertainty rises, the penalty for being wrong increases disproportionately. Cash begins to play a much more strategic role in this framework. In previous years, holding significant cash was often seen as a missed opportunity, especially when markets were consistently moving higher. Now, it becomes a form of optionality, the ability to respond rather than react, and the patience to wait for conditions where risk is more appropriately priced. The absence of urgency becomes an advantage in itself. At the same time, there's a noticeable shift towards simplicity. Complex strategies that rely on precise timing or favorable conditions start to lose their appeal. Instead, the focus moves toward assets and structures that are easier to understand, easier to manage, and less sensitive to sudden changes. Transparency becomes valuable, not just in terms of information, but in how predictable an investment's behavior is under stress. Risk management evolves as well. It's no longer just about diversification in the traditional sense, but about understanding correlations under pressure. Assets that appeared uncorrelated during stable periods can move together when liquidity tightens. Smart investors begin to account for that stress, testing portfolios against scenarios where multiple positions decline simultaneously. The goal is not to eliminate risk entirely, but to ensure that no single outcome can cause disproportionate damage. Another important element is the willingness to step aside. In a market that rewards constant participation, choosing not to act can feel counterintuitive. But experienced investors recognize that not every environment offers attractive opportunities. There are periods where the best decision is to observe, to gather information, and to wait for clarity. This discipline often separates those who preserve capital from those who gradually lose it through overexposure. You also start to see a redefinition of what constitutes a good investment. It's no longer just about potential return, but about the balance between return and risk. Opportunities are evaluated through a more stringent lens, with greater emphasis on downside protection. Scenarios are considered more carefully, and assumptions are tested more rigorously. Optimism is replaced by a more measured perspective, one that accounts for a wider range of possible outcomes. There's a behavioral shift that accompanies all of this. The emotional highs and lows and often drive market participation begin to flatten. Decisions become less reactive, more deliberate. The focus moves away from short-term fluctuations and toward longer-term positioning. This doesn't eliminate volatility, but it reduces the likelihood of making impulsive decisions in response to it. Importantly, this approach doesn't mean avoiding risk altogether. It means choosing where to take risk more carefully. There are still opportunities, even in challenging environments, but they are approached with a different mindset. Instead of chasing momentum, investors look for asymmetry, situations where the potential reward justifies the risk being taken. That selectivity becomes a defining characteristic of how capital is deployed. As more participants adopt this posture, it begins to influence the broader market dynamic. Liquidity becomes more cautious, flows become less predictable, and price movements reflect a higher degree of uncertainty. The aggressive optimism that once drove valuations higher gives way to a more restrained, calculated approach. And within that shift, the gap between perception and reality continues to close, not through a single event, but through a series of adjustments that gradually reshape how risk is understood and how capital chooses to move when the environment no longer offers the same margin for error.